Today we will be doing technical analysis on the S&P 500 for the week ending Friday, March 19th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Now, we will come back to this chart in just a couple of minutes, but let's start with the weekly chart of the S&P 500. So on this chart, each candlestick does represent 1 week of trading, and I've taken this chart back to November of 2020 just to give us a little bit of perspective as to what's been going on. Now, for the week, the S&P 500 was down 77 basis points, and we closed at 3913.10. And over here on the right, this is the weekly candle for this week's trading. And, I mean, it's a pretty volatile week, right? We had some trading above 39.50. That's this blue line here. But one thing I want you to take away from this chart is that even though we've had a few days where we've traded and even closed above 39.50, and we'll talk about that on the next chart, we have yet to have 1 week in the entire history of the S&P 500 where we've been able to close above 39.50. That's this top blue line here. So came pretty close last week, the week ending 3/12, where we closed at 39.43.34. So that is the all-time weekly closing high so far. Again, that was a week ago, 39.43.34. This week, of course, we gave up a little bit after making a new intra-week high, as you can see by the wick on the candle in the upper right where my cursor is moving. But the fact that we lost just a little bit of ground this week, 77 basis points, which, given all the volatility that we had this week, that wasn't too bad. But so far, the all-time closing high, weekly closing high on the S&P 500, 39.43.34. Now, before we move on to the daily chart, a couple other things I want to point out here is the 3,700 to 3,725, these two blue lines here. That's kind of the trading range that we really need to keep our eye on. We really want to stay above that level because we have not closed beneath 3,700 on the S&P 500 so far during 2021, and you can see that on a weekly basis, the lowest weekly close we've had, 37.14.24, and again, I'm talking about for calendar year 2021 so far. 37.14.24 is the lowest weekly close we've had, and that's right here. We've had some trading beneath 3,700 on the intraday, but as you'll see in the next chart, we haven't had any closes, daily or weekly, below 3,700 on the S&P 500 during calendar year 2021. So we really do want to stay above this 3,700 level. If at some point over the next few weeks or months we start to roll over and close beneath 3,700, you'll know we have a problem. The next chart that we're going to look at is a daily candlestick chart of the S&P 500, and it goes back to the very last trading day of 2020. So on December 31st, 2020, that's this candle here, you can see that we closed at 37.56.07. So that was also, of course, our starting place for 2021. But before we talk about that, let's get over here to the right and talk about what happened this week in the S&P 500. So these last 5 candlesticks right here in the upper right-hand corner. The first thing I want to point out is that on Monday, the 15th, that was the very first day ever in the history of the S&P 500 that we were able to close above 39.50. So this week, even though we closed lower, as we just looked at in the weekly candlestick chart, the previous chart, on a daily basis, we had the very first close above 39.50 right there, and we had 3 days this week, Monday, Tuesday, and Wednesday, where we successfully closed above 39.50. That's this blue line here. On Wednesday, the 17th, Fed Chair Jerome Powell, I just abbreviated that FCJP, Fed Chair Jerome Powell spoke. They talked about the fact that they're not going to raise interest rates right away. And initially, the market liked what it heard, and we went to a new all-time daily closing high on the 17th on Wednesday, and we also hit what is right now our all-time intra-day high on the 17th. So the new all-time daily closing high is 3974.12, and that happened on Wednesday. Also on Wednesday, we hit our all-time intraday high. I just abbreviated that ATIDH, 3983.87. So Wednesday the 17th, pretty important day in the S&P 500, new all-time closing high and an intraday high. However, overnight, I guess, market participants, everybody, dissected and parsed every single word the Fed chair had to say, and the markets got nervous and sold off pretty hard on Thursday, taking us back below 39.50. And then, of course, today on Friday, the 19th, we opened lower, and then we're able to kind of creep our way back. And we actually were positive for a good part of the afternoon. And then during the last part of the afternoon, the market sold off. We closed down 6 basis points today, so not a lot, but we had a slightly lower close today, down 6 basis points. So had a couple of days here where we closed under 39.50. And again, we closed today at 39.1310. So, we're still closing above 3,900. That's great news. But so far, only 3 daily closes above 39.50. All of them happened this week. So that's great news. The fact that we kind of closed at the lows of the week, that's not, at the ultimate lows, right? We hit the intraday low of 38.8675 today. But the fact that on a daily close, today's close was the lowest daily close of the week. I don't really like that, but I'm glad that we only gave up 6 basis points today. So hopefully, the market got its jitters out of the way here over the last couple of days, and next week we can continue to move higher. Now, let's go back and recap what's happened so far this year. There's been a lot of volatility in the market, and I just want to kind of get you caught up here so you know exactly where we're at. Now, we already know that we finished up 2020 at 3756.07. The first day of trading for 2021 is right here, and that's January 4th, and so far, we hit our lowest point in the markets for 2021 on January 4th, where we had an intraday low of 3662.71. And so far, that is also the lowest daily close we've seen in the S&P 500 for calendar year 2021, where we closed at 3,700.65. Now, you may remember on the previous chart, on a weekly chart, I pointed out that we haven't had any closes, either daily or weekly, below 3,700 so far for 2021, and that's exactly what I was talking about. We've had a few days where we've had some trading, intraday trading below 3,700. First couple days of 2021, and then right here. But so far, the lowest daily close we've had for this calendar year was the very first day of trading, and that's January 4th, closed at 3,765. Made our way up and had a little overhead resistance at 38.20, as you see here. Finally got above that, had some overhead resistance at 38.60, and then ultimately got rejected, rolled back over, checked back to this 3,700 level on the last day of January. So during January, we kind of round tripped, right? We started here, ended not too differently, and then February is where we really started to make some progress, got back above the 38.20 level right here on February 2nd, and then climbed our way up and hit what was at the time the all-time intraday high on February 16th, but had an intraday reversal. You can see that right here where we had a negative candle, and that set this 3.5-week downtrend in motion, as you can see here with this downtrend line. And of course, we know we got back above that at the tail end of last week, but we sold off for 3.5 weeks and had a couple of closes, daily closes below 38.20. One right here, one that barely closed below 38.20 right here, and then this one here. But so far, since February 2nd, we've only had 3 daily closes in the S&P 500 below 38.20. So the 38.20 level and 38.60, but really 38.20 is a really important short-term support level. We do not want to see the S&P 500, especially after this 3.5-week test, if you will, that we finally passed and got back above that level. got back above this downtrend. We definitely don't want to see the market roll over and start to close lower next week. If that does happen, though, just keep in mind 38.60 and 38.20 are the next support levels below where we are trading. And then if 38.20 for whatever reason does not hold, 3,700 is that next real level of support on the S&P 500. So we want to make sure that we stay above those levels. Real quick here, after we hit the lows during this 3.5-week downtrend, the low that we hit during this last pullback, 37.23.34 intraday, and then we were able to climb back out of that. We did have some kind of ugly candles, if you will. We had 4 days right here where we closed in the bottom half, and I just abbreviated that B1/2C for bottom half closes. You generally don't want to see the market close in the bottom half of the trading range, right? But we had 1, 2, 3, 4. You can see on these candles, the market was closing in the bottom half of the trading range. Here on Friday of last week, we finally had a nice looking candle there where we closed towards the high end of the session. That is a much better looking candle. Followed it through with Monday where we got back above, we got above and closed successfully above 39.50 for the first time ever. You can see we had a little bit of trading last week above 39.50, but couldn't hold it. But again, this week, 3 days where we successfully closed above 39.50, but ultimately rolled over and closed beneath that. So it's hard to say what next week brings. I'm glad that we only sold off 6 basis points today, Friday the 19th. So hopefully what that tells us is that the market between yesterday and today got its selling out of the way. And the fact that we didn't close at today's lows, I find to also be encouraging. Today's low again, 38.8675. We closed at 39.1310. And so I do like the fact that we closed above 3,900 and the fact that we only lost 6 basis points for the day. So hopefully just a couple of days of selling here and we can get back to trading above and closing above 39.50 and then work our way towards that 4,000 level on the S&P 500 over the next couple of weeks. But guys, there's no way to know, okay? I mean, this market could go either direction from here. So just keep that in mind. Want to be one of the most knowledgeable investors on the planet? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? Watch the balance of this video to learn more. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy-to-understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's 2 major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then of course the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market. And it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule. And the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least one or two emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.